Today we're going to look at the company Altria Group, headquartered in the United States and traded on New York Stock Exchange under the ticker MO. Please stay tuned for the important disclosure information at the conclusion of this video. Altria Group's story begins in 1847 when Philip Morris opened a small tobacco shop on London's Bond Street. By the early 20th century, the business had expanded to New York, eventually evolving into the corporate giant Philip Morris companies throughout the mid to late 1900s. The company dominated the tobacco industry with the rise of the Marlboro brand, while simultaneously diversifying into the food and beverage sectors, famously acquiring Miller Brewing and Kraft Foods. A pivotal turning point arrived in 2003 when the company rebranded as Altria Group to distance itself from the singular tobacco identity and reflect its broader portfolio. Around this time, Altria began a series of massive structural shifts. In 2007, it spun off Kraft Foods, and in 2008, it executed one of the most significant moves in corporate history by spinning off Philip Morris International. This separated its international cigarette business from its domestic operations, allowing Altria to focus exclusively on the U.S. market. Having traded on the New York Stock Exchange for over 6 decades, Altria has transitioned from a traditional cigarette manufacturer into a modern tobacco plus enterprise. In recent years, the company has pivoted toward harm reduction products, marked by major investments in oral nicotine and e-vapor technology. Today, headquartered in Richmond, Virginia, Altria remains a staple of the S&P 500, defined by its massive domestic market share and its status as a premier dividend king, with over 50 years of consecutive dividend increases. Altria Group operates as a powerhouse holding company centered on the manufacturing and sale of nicotine products, primarily for adult consumers in the United States. Its business model is built on the immense cash flow generated by its traditional smokable products, which it uses to fund a massive strategic pivot toward a smoke-free future. The company's core structure is divided into 3 primary segments: smokable products, oral tobacco, and e-vapor. The smokable division remains the dominant financial engine, anchored by Marlboro, which commands over 42% of the U.S. cigarette retail market. While Altria was once a global conglomerate, its market is now almost exclusively domestic. Following the 2008 spin-off of Philip Morris International, Altria focused its operations within the U.S. to navigate a specific regulatory and legal landscape. However, it maintains international exposure through strategic equity investments, most notably a significant stake in the global brewer Anheuser-Busch InBev. The company's target customers are adult nicotine consumers who are increasingly seeking alternatives to traditional cigarettes. To meet this demand, Altria is aggressively scaling its smoke-free portfolio, which includes on! Nicotine pouches and the recently acquired NJOY e-vapor brand. By leveraging an unparalleled distribution network of over 200,000 retail points, Altria maintains its market leadership even as cigarette volumes decline, using its pricing power to deliver consistent value to its shareholders. Altria's financial journey over these 20 years reveals a masterclass in defensive business strategy. In the mid-2000s, the company was still a massive, diversified conglomerate, but the 2008 spin-off of Philip Morris International marked the definitive end of its global cigarette dominance. This transition effectively reset the revenue baseline, as shown in the dip between 2005 and 2006, leaving Altria to focus entirely on the lucrative but shrinking U.S. market. From 2010 to 2021, the company entered a decade of steady-state growth. Despite consistent 3 to 5% annual declines in cigarette shipment volumes, Altria successfully grew its smokable revenue from $15 billion to a peak of over $18 billion. This was achieved through extraordinary pricing power, increasing the price per pack at a rate that more than offset the loss of customers. During this same window, the oral tobacco segment, fueled by premium brands like Copenhagen, quietly doubled its revenue, proving to be an essential high-margin secondary pillar. The most recent 5-year period, 2021 to 2025, represents a more complex chapter. Total revenue peaked in 2021 at $21 billion, but has since begun a gradual decline as traditional cigarette consumption faces stiffer headwinds from both health trends and the rise of the e-vapor market. The sharp drop in the all-other category after 2021 reflects the strategic sale of Michel Wine Estates, a move designed to shed non-core assets and double down on nicotine alternatives. Today, while smokable products still provide the vast majority of income, the company's financial health is increasingly tied to its ability to scale smoke-free revenues toward its stated goal of $5 billion by 2028. To understand expenses of Altria Group, one must follow the story of a company that has successfully insulated itself from a declining product volume by leveraging extreme pricing power and operational efficiency. The initial years of this study, 2006 to 2008, represent a period of massive consolidation. Following the separation from Philip Morris International and Kraft, the total revenue reflects only the domestic U.S. markets. As we move into the middle decade, specifically between 2011 and 2018, the table illustrates a masterclass in margin expansion. Even as cigarette smoking rates declined in the United States, Altria's revenue grew steadily from roughly $16 billion to nearly $20 billion. This was not because they were selling more cigarettes. It was because they were increasing prices consistently. More importantly, the cost of goods sold remained relatively stable or even decreased as a percentage of revenue due to manufacturing efficiencies and a shift toward higher-margin premium brands like Marlboro and Copenhagen. This dynamic allowed operating cash flow to increase from $3.6 billion in 2011 to over $8 billion by 2018. One of the most critical columns to observe is other expenses/income. In Altria's case, this line is often a catch-all for massive non-cash items, including equity earnings from its stake in Anheuser-Busch InBev and periodic legal settlements. The research and development column tells its own silent story of the company's future. For years, R&D remained a small, steady expense of roughly $150 to $250 million. However, as the regulatory landscape shifted and consumer preferences moved toward harm reduction products, these figures became the lifeblood of the company's vision. The investment in products like NJOY e-vapor and on! Nicotine pouches is reflected here, representing a strategic bet that these categories will eventually replace the shrinking cigarette revenue stream. Unlike tech companies that spend 15 to 20% of revenue on R&D, Altria's capital-light model allows it to keep R&D at less than 1% of revenue, preserving more cash for dividends. Turning to the final columns, free cash flow, and its adjustment for stock-based compensation, we see the metric that investors value most. Altria is unique in that its capital expenditures are remarkably low for a company of its size, often representing only about 1% of total revenue. This means that almost every dollar of operating cash flow is converted directly into free cash flow. While many modern tech firms use stock-based compensation to inflate their perceived cash flow, Altria's SBC is negligible, rarely exceeding $100 million annually. This makes the FCF SBC column the most honest look at the cash available to pay dividends and buy back shares. As of 2025, with an adjusted free cash flow nearing $9 billion, Altria remains one of the most consistent cash generators in the S&P 500, a status it has maintained through 2 decades of unprecedented industry disruption. Altria's capital allocation history is best understood as a series of strategic eras. In the earliest years of this analysis, 2006 and 2007, the company's financials included the massive cash flows of its global operations before the spin-off of Philip Morris International in 2008. This explains the high dividend and repurchase figures in those years, which were essentially the final global payouts before the company transitioned into a purely domestic U.S. entity. After the 2008 reset, the company entered a period of disciplined deleveraging and steady growth, where dividends were prioritized above almost all other uses of cash. Between 2009 and 2018, the narrative is dominated by 3 massive strategic moves that reshaped the balance sheet. First, the 2009 acquisition of UST for approximately $10 billion was a foundational pivot that brought the smokeless tobacco leader U.S. Smokeless Tobacco Company into the fold. This move was largely funded by debt. nearly doubling the company's financing obligations from $6.8 billion to over $13 billion in a single year. Following this, the company spent nearly a decade maintaining a steady state, where it used its immense pricing power to grow free cash flow from roughly $3.5 billion to $8 billion, all while keeping its debt levels relatively flat and its dividend payout ratio exceptionally high. The year 2018 represents the most significant spike in the capital allocation table. This was the year Altria made its high-profile $12 billion investment in Juul Labs and a $2 billion investment in Kronos Group. To fund these ventures, Altria tapped the debt markets aggressively, causing its financing debt to jump from $13.9 billion to nearly $26 billion. The following years, 2019 to 2021, were defined by the financial fallout of these investments, as write-downs occurred, and the company focused on maintaining its dividend streak despite the increased leverage. During the 2020 pandemic year, the company notably paused its share repurchases to preserve liquidity, which is reflected in the $0 entry for that year. By 2024, the company executed its largest share repurchase program in over 20 years, returning $3.4 billion to shareholders, funded by the strategic partial sale of its stake in Anheuser-Busch InBev. Throughout this entire 20-year span, the one constant has been the dividend. As a dividend king, Altria has ensured that its payout to shareholders remains the primary destination for every dollar of free cash flow, regardless of the broader shifts in its debt or acquisition strategy. Altria Group is currently led by William Gifford, a seasoned executive who has spent over 30 years within the Altria family of companies. He joined Philip Morris USA in 1994 and ascended to the top leadership position in April 2020. His tenure has been marked by a significant moving beyond smoking transition, though he is set to retire on May 14, 2026. For the 2024 fiscal year, Gifford received a base salary of $1.4 million, while his total compensation reached approximately $27 million. The ownership of Altria is overwhelmingly dominated by large financial institutions, which collectively hold roughly 61% of the company's shares. Individual insiders, including directors and executive officers, own a very small fraction of the company, typically estimated at less than 1%, which is common for a corporation of this scale. The remaining 38% is owned by the general public, consisting largely of retail and individual investors attracted to the company's history of high dividend yields. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. In the bull case, Altria successfully transforms its identity, moving from a cigarette manufacturer to a diverse nicotine technology company. The primary catalyst is the rapid, high-margin scaling of NJOY e-vapor and on! Nicotine pouches, which eventually offset the volume declines in Marlboro. In this story, the FDA provides a clear, predictable pathway for modified-risk tobacco products, allowing Altria to convert its massive existing customer base to less harmful alternatives. With higher margins on smoke-free products and a reduced tax burden compared to combustibles, the company expands its operating cash flow margin toward 48%. This windfall allows Altria to aggressively hike dividends by 3% annually and significantly reduce share count through buybacks, all while making tactical acquisitions in the international space to fuel a 2.5% revenue CAGR. The base case assumes a continuation of the status quo, a slow, managed decline of the cigarette business balanced by the steady but non-explosive growth of oral nicotine. In this scenario, Altria utilizes its immense pricing power to keep revenue essentially flat or slightly positive despite year-over-year volume drops. The smoke-free portfolio grows enough to defend market share, but faces stiff competition from both global rivals and illicit disposable vapor products. Capital allocation remains predictable, with dividend growth at 0.5% and stock repurchases discontinue. The company makes small, bolt-on acquisitions to maintain its technological edge but avoids the massive, high-risk bets of the past. It remains a cash cow that prioritizes current yield over aggressive expansion, maintaining a stable 37% cash flow margin as it slowly transitions its portfolio. The bear case explores a future where Altria is squeezed between aggressive federal regulation and a failure to capture the next generation of nicotine consumers. Catalysts for this decline include a potential federal ban on menthol or a mandate to reduce nicotine levels to non-addictive amounts in cigarettes, which would crash the cash flow engine before the smoke-free business is ready to take the baton. In this narrative, Altria's newer ventures fail to achieve the necessary scale or face unexpected health-related litigation, leading to a steady erosion of margins. Revenue and dividends decline, buybacks cease, and the company's valuation is compressed as investors fear a terminal decline. In the bull case scenario, we assume the following: revenue growth at 2.5%, operating cash flow margin at 48%, capex growth at 3%, stock-based comp growth at 2%, dividends growth at 3%, stock repurchase at 5%, acquisition spending in the next 20 years at $15 billion. Stock repurchases assumes price-to-sales ratio of 4. With this discounted at 7.5%, dividend model yields $65 worth of value per share in 20 years, $87 in 30 years, and $106 in 40 years. In the base case scenario, we assume the following: revenue growth at 0.5%, operating cash flow margin at 37%, capex growth at 1.5%, stock-based comp growth at 1.5%, dividends growth at 0.5%. Stock repurchase is discontinued. Acquisition spending in the next 20 years at $5 billion. Stock repurchases assumes price-to-sales ratio of 4. With this discounted at 7.5%, dividend model yields $46 worth of value per share in 20 years, $54 in 30 years, and $58 in 40 years. In the bear case scenario, we assume the following: revenue growth at -2%, operating cash flow margin at 25%, capex growth at -1%, stock-based comp growth at 1%, dividends growth at -1%. Stock repurchase is discontinued. Acquisition spending in the next 20 years at $2 billion. Stock repurchases assumes price-to-sales ratio of 4. With this discounted at 7.5%, dividend model yields $20 worth of value per share in 20 years, $23 in 30 years, and $24 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.